Hi everyone, my name is Eliza Pineda, and I chose to do this presentation and final project on the Great Recession that took place in 2007 and 2009. And this, we're just gonna go over some causes, consequences, and lessons that we learned and impacted us until today. So, the Great Recession, as officially defined by the National Bureau of Economic Research, lasted from December 2007 to June 2009. However, its effects were felt long before and after these dates. It stands out as the longest and deepest economic contraction in the United States since the Great Depression, prompting direct comparisons in its scales and impact. It wasn't just a mild downturn, it was a period marked by a sharp contraction in GDP, massive job losses, and a severe crisis that brought the global financial systems to the brink. I just have a graph right here, right above me, about how workers lost their job in the Great Recession. So the next slide, primary causes. At the heart of the Great Recession was the spectacular collapse of the housing market. For years leading up to 2007, a combination of factors created an unsuitable housing bubble. Persistently low interest rates made borrowing cheap, spurring demand. Crucially, lending standards became incredibly lax, so called subprime mortgages were issued to borrowers with questionable credit histories, often with adjustable rates and little documentation of income or assets. These risky mortgages were then packaged together, often with safer loans, into complex financial instruments called mortgage backed securities or MBS and sold to investors globally. To make matters worse, credit default swaps, essentially insurance policies against MBS defaults, proliferated, creating a tangled web of interconnected risk. The Financial Crisis Inquiry Commission's report meticulously detailed how this system created a house of cards. And this is just a real home price index here. Some secondary causes, while the housing market was the fuse, several other factors amplified the crisis. Years of financial deregulation had weakened oversight, allowing banks to engage in increasingly risky behaviors. With little accountability, many financial institutions took on excessive leverage, meaning they borrowed heavily to amplify their investments and became deeply entangled in complex derivatives like CDS. The global financial system was incredibly interconnected, so when default started in the US housing market, the shock wave spread rapidly. Furthermore, rating agencies, which were supposed to assess the risk of these complex financial products, often assigned overly optimistic ratings, misleading investors, and of course, predatory lending. Practices played a role in pushing unsuitable mortgages onto vulnerable borrowers. Raghuram Raja's fault lines brilliantly dissects these underlying structural issues that made the system so fragile. Some economic effects that took place were swift and devastating. The US GDP experienced its sharpest contraction since the Great Depression. The labor market was dismantled, with unemployment soaring to 10% in October 2009 and over 8.7 million jobs disappearing. Banks facing massive losses and uncertainty se- severely tightened lending standards, leading to a credit crunch that choked off the access to capital for business and consumers alike. The stock market plunged, wiping out trillions in wealth. Millions of Americans lost their homes to foreclosure, leading to a massive erosion of household wealth. Data from the Federal Reserve Bank of St. Louis clearly illustrates the dramatic scale of these economic disruptions. Social effects. Beyond the economic statistics, the Great Recession had a profound human cost. It exacerbated poverty and inequality with vulnerable populations, disproportionately affected. The immense financial insecurity led to a documented decline in mental health with rising rates of stress, anxiety, and depression. Many young adults deferred major life decisions such as getting married, buying a home, or starting families due to economic uncertainty. Homelessness increased, and the retirement savings of millions were severely depleted, forcing many to delay retirement. Perhaps most enduringly, there was a specific erosion of public trust in financial institutions and even in government's ability to protect its citizens. Government response. Faced with an unprecedented crisis, the government responded with a combination of fiscal and monetary policies. On the fiscal front, the Troubled Asset Relief Program, or TARP, was enacted in late 2008, initially providing up to 700 billion dollars to purchase toxic assets and inject capital into failing financial institutions, including major banks and the auto industry. This was a highly controversial but widely credited move for preventing a complete financial meltdown. Following that, the American Recovery and Reinvestment Act of 2009, a significant stimulus package, provided nearly 800 billion dollars for infrastructure projects, education, healthcare, and tax cuts aimed at boosting demand and job creation. These actions ignited a fierce debate between proponents of government stimulus and those advocating for austerity. So some more government responses. The Federal Reserve under Chairman Ben Bernanke implemented equally unprecedented monetary policies. The federal funds rate, their primary tool, was slashed to effectively zero. More notably, the Fed engaged in multiple rounds of quantitative easing, or QE. This involved the large scale purchase of mortgage banks securities and long term treasury bonds. The goal was to lower long term interest rates directly, making borrowing cheaper for consumers and businesses, and to inject massive amounts of liquidity into the financial system. The Fed also acted as the lender of last resort, providing emergency loans to a wide range of institutions to prevent systemic collapse. These actions sparked debate about the too big to fail doctrine and the potential for more hazard. Ben Bernard's memory, The Courage to Act, offers a first first-hand account of these critical decisions. So, some long term effects that we still are facing. The Great Recession left a lasting imprint on the US and global economies. The recover the recovery was notably slower than in previous recessions, often referred to as a jobless recovery. For a significant period, national debt swelled due to stimulus spending and decreased revenues. In response, comprehensive financial regulatory reform, most notably the Dodd-Frank Act, was enacted to prevent a recurrence of the crisis. The housing market entered a new normal with much stricter leading standards. Unfortunately, the recession also exacerbated existing trends of income inequality and wage stagnation for many on a broader societal level. The economic discontent generated by the crisis has been widely cited as a contributing factor to increased political polarization and the rise of populist movements globally. Lessons learned. The Great Recession was a harsh but invaluable teacher. Perhaps the most critical lesson was the profound nature of systemic risk, how the failure of one part of the financial system can cascade throughout the entire global economy. It underscored the absolute importance of robust financial regulation to prevent excessive risk taking and predatory practices. While monetary policies were aggressively deployed, the crisis also highlighted the limits of monetary policy alone and the critical role of fiscal stimulus in the Great Recessions. The need for early and decisive intervention was also clear. Inaction can quickly spiral into catastrophe. It forced policymakers to grapple with the difficult trade offs between preventing systemic collapse and the perception of moral hazard for bailouts. Finally, it reinforced the importance of consumer protection, particularly in lending practices. Sources, these are just some of my sources, and thank you guys for watching. And I hope you guys enjoyed this presentation. And these are just some highlighted things that took place during this time. And I hope you guys gained some more knowledge about it. Thank you.